All right, let's jump right into this explainer. Today, we're putting defense drone maker RCAT Holdings through the absolute ultimate financial stress test. Now, if you follow the aerospace and defense sector, you already know RCAT is making serious headlines right now, with massive military contracts and just explosive growth. But as an investment analyst, I always have to take a step back and ask, does the underlying financial math actually support all this hype? Well, we're going to find out.
Here's a quick look at our roadmap. We'll kick things off with a snapshot of RCAT, then run it through the classic Buffett, Lynch, and Graham lenses. After that, we'll build out a base case DCF, check out some alternative models, and finally wrap it all up with our synthesis and final verdict.
Section 1. Snapshot. RCAT Holdings. Understanding the Defense Tech Paradox.
So we're looking at a company trading right around $9.28 a share, which commands a rather robust $1.41 billion market capitalization. They build advanced unmanned systems, specifically the Black Widow drones, for the U.S. military and NATO allies. But here's where things get really interesting. Just look at the sheer tension between their massive defense contracts and their heavy bottom-line losses. It's basically the defense tech paradox in a nutshell. I mean, they are incredibly well-funded, sitting on an absolute fortress of $131.9 million in cash. And yet, they are currently operating with a brutal negative 138.4% profit margin, posting a $26.6 million net loss in just a single quarter.
On one hand, you have this mind-blowing 849% year-over-year Q1 revenue growth. I mean, they jumped from $1.6 million to $15.5 million in a single quarter, driven almost entirely by scaling up deliveries for the U.S. Army's Short-Range Reconnaissance, or SSRR program.
But on the other hand, you have a punishing negative 56.4% return on equity. And that's happening as the company scales operations, builds up over $50 million in inventory, and just burns through capital to meet these massive production demands.
Section 2. The Buffett Lens. Seeking the Economic Moat and Owner Earnings. Okay, so let's bring in the Oracle of Omaha. Warren Buffett looks for very specific traits: a durable economic moat, manageable debt, and consistent earnings. Now, looking at his checklist, RCAT actually passes two crucial tests right out of the gate. Economic moat? Pass. Their NDAA-compliant American-made drones are deeply embedded in U.S. Army and NATO procurement cycles. Manageable debt? Absolutely pass. With nearly $132 million in cash and only $350,000 in short-term debt, their balance sheet is practically bulletproof. But here's where Buffett would walk away. Why? Because consistent earnings simply don't exist yet. ROE is deeply negative, and owner earnings are totally non-existent, with a negative operating cash flow of roughly $32 million in Q1 alone. For Buffett, without a margin of safety on current earnings, it's a hard pass.
Section 3. The Lynch and Graham lenses. Growth potential versus defensive value. Moving on to Peter Lynch. Now, for Lynch, RCAT is a classic fast grower. He loves a strong balance sheet, and RCAT's massive 11.0x current ratio is nothing short of spectacular. Plus, their PEG ratio, which compares price to earnings against growth, sits at a really appealing 0.7x. Lynch traditionally considers a PEG under 1.0 to be a flashing buy signal. However, there's a pretty massive caveat here. Because RCAT has a negative PE ratio of negative 12.7x, those historical growth metrics are highly speculative. Still, for Lynch, the explosive top-line growth combined with that clean balance sheet makes this a solid speculative buy.
Now, Benjamin Graham, the father of value investing, he is a totally different beast. He demands adequate size, absolute earnings stability, and he uses a very strict intrinsic value formula. It's the square root of 22.5 multiplied by earnings per share multiplied by book value per share. And this just brilliantly illustrates the problem for strict value investors. If we plug in RCAT's annualized EPS of negative 88 cents and their book value per share of $2.21, Graham's formula results in a mathematical error. You literally cannot take the square root of a negative number. Graham wouldn't just avoid this stock. His defensive checklist wouldn't even let it in the building.
So, this brings us to a crucial point. If the old-school value legends are entirely out, we have to look to the future to justify the current price tag. How exactly does Wall Street look at a company burning this much cash and arrive at a $1.4 billion valuation? Section 4. DCF Valuation Base Case. Projecting future cash flows. Well, this is where the discounted cash flow, or DCF valuation, comes into play. It's how modern analysts evaluate high-growth companies that aren't quite profitable yet. Because RCAT's current free cash flow is so deeply negative, we have to make some forward-looking assumptions.
We start by bridging their current cash burn to management's stated short to medium-term revenue target of $150 to $180 million. From there, we have to assume they'll eventually reach industry average profitability margins. And crucially, because they're a highly volatile, small-cap defense stock, we absolutely must discount those future cash flows back to today using a high weighted average cost of capital, or WACC, somewhere between 12 and 14%.
So, when we run that sensitivity analysis on our DCF model, here's what falls out. If we assume a high 12 to 14% discount rate to account for all that execution risk, and a standard 3% terminal growth rate, our base case fair value lands somewhere between $5.60 and $8.50 per share. Honestly, even if we use a highly optimistic 4% terminal growth rate, the fair value only stretches to $9.40. What this tells us is that at its current $9.28 price tag, the stock is basically fully valued, or maybe even slightly overvalued, based purely on modeled future cash flows.
Section 5. Alternative Valuation Models. Comparing apples to drones. But, a DCF is just one tool in the shed. We need to pivot to comparable multiples to get a full 360-degree view. Looking at a comparable enterprise value to revenue model against pure-play defense drone peers, the picture clarifies a bit. RCAT is trading at roughly a 6.8x EV to sales multiple. Now compare that to Kratos, which is a much more mature company trading around 3.5x, and RCAT looks pretty expensive. But if you compare it to the industry leader, AeroVironment, which is trading at an 8.0x multiple or higher, RCAT suddenly looks a bit more reasonable. RCAT's valuation is indeed stretched by traditional standards, for sure, but its explosive 849% growth rate commands that premium multiple in the eyes of the market.
Section 6. Synthesis and Final Verdict. The Ultimate Scorecard.
Okay, let's bring it all together. As you can see, traditional value frameworks fail this stock entirely. Buffett and Graham demand a margin of safety based on current, tangible earnings. They'd both say stay away. The discounted cash flow model suggests the stock is currently fairly priced, landing at a solid hold. But growth-focused Wall Street analysts, they're zeroing in on those massive military contracts and the Peter Lynch-style hypergrowth. They have a consensus median price target of $21. That's more than double the current price, making it a strong buy in their eyes.
Ultimately, RCAT is an incredibly well-funded hypergrowth story with just undeniable top-line momentum. They've got the cash to scale, and they're aggressively acquiring tech, like APM swarming software, to build out that moat. But the bottom line reality? Those massive operating expenses and a deeply negative net margin? Well, that makes it strictly a speculative play. It's a buy for high-risk growth portfolios banking on future defense spending, and a hard avoid for your traditional value investors.
Which leaves us with this final, provocative thought. Scale is absolutely critical in modern warfare, and RCAT is definitely proving they can scale production. But how long can the market ignore the bottom line? Is growth enough to sustain a billion-dollar valuation, or will the fundamentals eventually have to catch up to the hype? That is the billion-dollar question you've got to answer before adding RCAT to your portfolio.